going to finally be the day we get that pivot? Are we going to see Jerome Powell pivot from 75 basis points to 50 basis points? But either way, even if he doesn't, are we finally going to understand? When are we going to see our 50 basis points? Will it be at the next meeting in December? Either way, we could see some positive reactions here in the market. I'm going to break down exactly what I'm expecting. We've got about 14 minutes or so until the FOMC announcement. We will be covering that off today, and then we'll be waiting for the press conference. Remember, you have the announcement, you then have the press conference. Both are two different things. Let me know in the comments if you're trading this or if you're just interested for your long-term investment purposes. Let's see who we've got in the chat. Christian, Stu, good to see you. Barney, good to see you again. Hope you're doing well, mate. Wakaz, good to see you. Brandon, Robert Powell. How long until the Fed announcement? The announcement will be in 14 minutes till we get the announcement. 14 minutes. Alexis, good to see you, buddy. Rolo, good to see you. Pele, good to see you again, buddy. Oh My Eyes, Ian, familiar faces, Mike, good to see you again as well. Nice, good. We've got all our regular batch ready here. Vicky, good to see you. Nabil, good to see you. Christian, Mr. Got Plenty. I see you all in the chat, guys. Feel free to shout out what you're expecting, a 75 or a 50 basis points or 100 basis points. None of this is out of the realms of possibility. We've got 13 minutes or so. I want to give you my research because I'm a sad guy like that. And I studied the last 4 FOMC meetings. I'm going to give you my conclusion of what we saw and what this could mean. BJ Kote, good to see you again. You're DCAing. Good stuff. Special K, good day, everyone. Kwame, good to see you on the live as well. Beyond Infinity, Sharky, Stanton, you guys are smashing it. Smash up the likes, guys. Over 100 of you in here, but not that many of you hitting the like. Please smash up the like in advance. And then if you don't like the stream, you can take it off. But don't blame me for the rate hike, right? Don't undo your like because of Jerome Powell. That's not my doing. That's Jerome Powell. So if we get 75 basis points or 100 basis points, do not rescind your like. Now, I need to bring you up to speed. There's a few things. Just hot off the press, the ADP jobs figure came out. We just covered this with our course members. Again, if you guys want to join that, ijaz.uk/member, you get all the extra insights and Q&A with me one-on-one 3 times a week. So what you can see here, private payrolls rose to 239k versus 195. So in other words, the jobs market is really hot still. And the wage increased by 7.7%. This gives you risk of wage price inflation. This is not good from the Fed. For the Fed. So I did some digging because I wanted to understand exactly what is going on. So I looked at the report because I'm sad. Already told you I'm sad. And what I found was that actually the majority of the different industries were not increasing in payrolls too much. In fact, majority of them were decreasing. Information, financial activities, professional business services. It was leisure and hospitality which accounted for the huge swing. So whilst the figure may seem a little bit scary, the labor market is still quite tight, and we are seeing some signs of the demand destruction eventually coming. So this is something for Jerome Powell to keep an eye on, and I made a note of it as well. Now, what I did was I looked at the last 4 FOMC meetings, and what you can see, there's a bit of a pattern here. So they were all positive, right? Starting from May. May was really positive. June was positive. July, 8% day on that return. September was down because the market had a huge expectation. They thought that he would pivot. Many people at the time were saying, oh, he's not going to do 75 basis points again. It's going to be 50 basis points. And you saw what happened. We got 75 basis points. Market didn't like that. Now, if we go and look at exactly what happened, this was back in May. You get the announcement candle. These are 30-minute candles, okay? Because remember, the announcement will happen at 2 p.m. Eastern time, and then half an hour later, you get the press conference, okay? Very, very important. So you'll see that. You had a huge volatile candle here. Bears pushed it to the downside. Bulls pushed it back, and then it ran during the press conference. Let's skip on to June, and you saw big redness when the announcement came out, lots of red in the market, and then a bullish engulfing candle. Again, if you don't know what that means, guys, ijaz.uk/TA, free TA course. There's no reason for you not to know all these terminologies. Go and check that out. You then had your big green candle, okay? So you can see, you got to wait for that press conference to come in because you do get that yo-yo factor coming in. Lots of volatility. On the situation on July the 27th, when we had the Fed meeting, it was a big 8% day, and they were happy with the announcement, and they were happy with the press conference. So you had a double pump. And then on September, you had your big dump here. This is a 5-minute candle, big dump here. And then it recovered through the press conference, and then it gave it all back up afterwards. So loads to take in today. And what I did was, to make things simple, I jotted down a few scenarios. And this is, again, what we were going through with course members earlier today to make sure everybody is prepared. Now, how I see it is there are 6 different options we can get, right? Now, there's 2 sets where you got 50 basis points, 2 sets where you got 75 basis points, and 2 sets where you get 100 basis points. And what I want to focus on is if you get 50 basis points and dovish, in other words, the press conference is dovish, Powell is saying things to protect the market and to be on the market side, then I'm expecting an S&P huge pump, right? Like, this is the pump of all pumps. This is the best outcome we can get today. Unfortunately, I don't think these two scenarios are possible. I don't think probable, sorry. I don't think they're likely to happen today. I'm going to explain why. Okay, so that would give you a 10 to 12% pump, in my opinion, here. On the S&P. Now, remember, Bitcoin can move faster in the S&P if it wants to. So just as a gauge, 10 to 12% I expect on the S&P if we get that. The next scenario is a little bit more likely than the top scenario, but still quite unlikely, is 50 basis points and hawkish. So he may do 50 basis points, but to cover that up, he may come out and still try to act tough, right? And say, yo, we still got a work to do to bring inflation down and unemployment is still high. So that could lead the markets to get a 4 to 5% pump on the S&P. Now for my more likely scenarios, okay? 75 base points. And again, I'm not just basing this just on me. Look at the market, okay? So if we look at this, I've just refreshed this. Let's refresh it live now because it does move a lot. Let's get that refreshed. And you can see this now starting to creep up, right? 15% of the market expects 50 basis points, the options I just shared with you. 85%, so the vast majority are expecting 75 basis points. So let's now come back into here. Come back into our little notepad here. And so this is my second most likely scenario. 75 basis points, and he's dovish, right, to counteract that. That could lead to, in my opinion, a 2.5%, 3% pump on the S&P and a bit of greenness in Bitcoin as well. I think that's a decent scenario to play out. Now, the most likely scenario, I think, is this. 75 basis points, he'll come out still hawkish, and we're probably going to be down 1 to 2%. Unfortunately, that is what I'm expecting. Right, because I think he's got to keep his foot on the noose of the market. The only thing which makes me shift towards this, where maybe he does the rate hike and dovish, or even maybe like this scenario here, the 50 basis points with hawkish, is if the midterms are playing on in his head and maybe Biden's had a word. That's what makes this one particularly interesting, because it's not as easy to predict because of next week's midterm. And also the fact that he's not seen the non-farm payrolls, or maybe he has seen them, but they're not out until Friday. Maybe he's at an earlier peak. So that's the situation I'm playing for here. Then you've got 100 basis points, dovish. Guys, make sure you smash that like button as I'm walking you guys through this. There's a lot of you in here. Please do smash the like so more people can jump into this stream and understand what is going on and monitor this press conference with us. Then I'm looking at this scenario, okay? This is the most common. But then people are writing off the fact that we couldn't see 100 basis points. Again, maybe we could, right? Maybe they come out and the mandate is to win the hearts of the people. People who are finding groceries expensive. Not the stock market. People who are finding groceries expensive, finding the fuel pump expensive. Maybe he comes out and he says, I'm on your side. I'm doing 100 basis points. I don't care about the stock market. I care about you guys. And again, a political move, right? And he could come across and do that. And that could lead the market down 4 to 5%. And if he comes out in the same way with hawkish, these two are rug pulls. This would be really painful, and we could be down 6-8% on the S&P, let alone Bitcoin. So these are the scenarios I'm playing out. Again, I'm expecting these 75 base points to play out, 50 or 100, and we're going to get some drama, and it's going to be fun because we're going to get a lot of volatility in this market. Guys, 7 minutes away from the Fed announcing their decision on interest rates. Are we going to get that flip-flop? That is what we're waiting for. Let's take a look at the comments, see what you guys are saying in here. Vicky says 75. Christian, if 75, then down. Dovish talks. What do we expect? We just covered that off. Andrew, hoping for 50, but expecting 75. Yep, same. I'm in the same camp. I'd love 50. 50 will give us some nice greenness. I just don't think it's going to happen. I think what we can get away with is 75, and maybe he can telegraph December will be 50. You know, maybe give us a clue that this will be the last 75. And I think markets will be happy with that. I think markets will move decently with that as well. MJab, Rolo, good to see you. Yes, indeed. Smash up the like button, people. Please do smash up like. It really does help me. I mean, I did a lot of research for this stuff, guys, before the meeting. It's not just like we jump on this live stream and everything's ready. I've got to research all this stuff, ADP jobs reports, looking at inflation, looking at the different outcomes of the markets. Let's see what else you guys are saying. Joshua Miller, can someone explain how Powell thinks raising rates will cause landlords to stop jacking up rent prices? That's a long conversation. We have to pick that up separately, but you got to remember CPI is actually owner's equivalence rent, which is a bit of a misnomer, which a lot of people get confused with CPI. Ijaz, will you be covering the rate decision as well as the speech? Yes, we'll be covering off both, Vicky. So make sure you stay here, stay tuned, locked and loaded. Keep me while you're having your dinner or whatever you guys are doing, depending on which countries you're in. Do keep me next to you. Not in that weird kind of way, but you can hear me speaking and covering this off. 219 watching versus, yeah, exactly. More likes, guys. More likes. Right. Okay. So now we've got those scenarios played out. I want to remind you of two things. One is the inflation, right? Inflation is improving, but look at this chart. It's not coming down enough. And the best way to look at that is to plot it on a line chart. Now, when it first came down, look at the gradient. Hopefully, I'm not getting too mathematical here, as I have a tendency of doing. The rate of change, the gradient, is slowing. And that's worrying, because if this goes like that, then the rate fell smaller, and then it fell smaller, and eventually you start becoming flat. It starts leveling off. Now, that could mean you have entrenched sticky inflation, which is what Jerome Powell does not want. So we've got to be careful, right? Everybody hoping for weaker interest rates. This could still mean pain for the market. So we've got to be very, very careful what we wish for. And there is a chance that Jerome Powell just cracks on and says, you know what? Forget the midterms. Forget what you guys are saying. I'm doing another 75 basis points. The fact of the matter is we missed expectations on the last CPI report. A lot of people seem to have forgot that. Earlier this month, we missed what the expectations were. I mean, if you come down here, you can see we missed those, right? So it's not great. So we've got to keep that in mind. Now, coming onto the chart pattern we're forming. And by the way, this is the chart we're going to be looking at when we're live in the next 4 minutes. In the next 4 minutes, we'll keep this open as we get the rate hike. And you'll be able to see the 5-minute chart of Bitcoin on the left and the S&P on the right for reference. Now, Bitcoin's in this important triangle, right? And what I want to monitor here are the different scenarios. So we just played out the different scenarios, and Bitcoin is like a coiled spring. It's been in this symmetrical triangle. So this is at the point where technical analysis says, you know what? We're not moving the market anymore. You need to wait for this decision. So what happens is, just like an aeroplane goes into a holding pattern waiting for landing, technical analysis does the same, right? Price action just goes into a holding pattern waiting for a direction. And right now, technical analysis doesn't help you know which direction we're heading in. This is all based on Jerome Powell and the words he's going to say in 3 minutes. Okay, so that's really important. Move to the upside. I want a higher high move on the upside. Even if we don't get the best case news of 50 basis points, if we get 75 and enough dovish that we can post a higher high, that's good, because this is a continuation pattern. We can move to the upside. Downside risks, I don't want to create this M pattern. I don't want to come back to 20K, because if we don't get support from 20K, if we soften, we could be creating that M pattern to the downside, which could again bring us back in those 19,000 prices. I'm not doing any buying at 19,000 range, only because my portfolio is quite solid at the moment, and I need to be seeing prices around 18,700 or lower below this channel for me to get excited buying any right now. In terms of a trade, you could take this trade on the breakout, on the move. Be very, very careful on FOMC days. You've got all the best traders in the world eagerly trading this announcement, scalping with the best tools available to man. So be very, very careful trading this, and obviously only trade what you're willing to lose. Make sure you've got your stop losses in place and you know what you're doing. Cool? All right. So 2 minutes to go. I think we're quite efficient here. What I'm going to do, let's just see if you guys can hear this. Drop me a comment if you can hear this.
The long end actually looking attractive. So I think more cuts should be priced into 24. We have only 100 basis points of cuts priced in. I think a recession is almost a done deal by the end of next year. So maybe it's not next year, but in 24, when the Fed starts to cut, I think they're going to have to cut a lot. So buying further out the curve, having flatteners on.
Right, could everybody hear that okay? Let me know in the comments if you could hear that. If you couldn't hear that, let me know. Need to make sure you have that ready for the press conference when we cover it. Also, what we've got here, good, you can all hear it. Great stuff. So, also, I'm going to have it here. We're going to have the PDF loading up here, and we're going to refresh, right? Remember, like we always do, we're going to be refreshing and making sure we get access to this. But now, sometimes it goes down. You know what it's like, guys. So, I'm going to have it here on my iPad as well. So, that way, we can make sure we get outcome and we find out the rate hike. So let me just keep that open here. Cool, not long left, guys. We've literally got a minute left. Make sure you smash up the likes. I'm just getting this prepared, so we're good to go, and we can start refreshing. Let me know your final shout out in the comments, guys. Put it in the comments. What are you expecting? What are you expecting in terms of the rate hike? We're going to take a look. Remember, we're currently at a Fed funds rate of 3 to 3.25. So 75 basis points means 3.75 to 4 Fed funds rates. When I open the document, if we see 3.75 to 4, that means 75 basis points. If we see 3.5 to 3.75, that means 50 basis points. I will walk you through that together. Let's get a refresh. Let's see how we're getting on here. Don't forget to smash up the likes, guys, if you're enjoying this coverage. And I'll be sure to give you this kind of coverage on all the key events which move crypto. Yes, we will. Okay. Come on, Jerome Powell. I just picture him like pressing upload, like with an evil face, like upload rate hike. Can you imagine if he's actually doing that? It'd be really funny. Okay. My clock has turned on the hour. I don't see anything yet. Still refreshing. They do take some time sometimes. I bet some of you in the States have it before I do. Okay, so refresh. Fresh. Oh, here we go. PDF. Let's open. 3 to 3.25%. Okay, 3 to. Nope, they've given me the old one again. Okay, so I'm gonna have to go to my iPad. Like, Oh, have they paused? I think they've done a pause, guys. They've not increased the interest rates whatsoever. 0.75, 75. Market is going to go nuts, guys. That is insane. Did they just pause it? I think they've just gone for a pause. Let me just confirm, guys. It's not playing out. Let's just take a look at the markets here. I'm going to pull this up. I think they've paused. Yep, another 3 quarters, 75 basis points again. So we didn't do the 50, but the markets are moving. Very interesting. Does that mean the markets, this is an odd one. So be careful here, guys. This is just traders playing games. I would be very, very careful here. That is interesting. They've done their 75 basis points. Just pull up the PDF. Just pull that up together. Okay, so definitely on the November 1, so they've given that the committee seeks to achieve maximum employment. Committee decides to raise target Fed funds rate to 3 to 3/4. Committee anticipates ongoing. Okay, let's see the reaction here.
That's what you've got. Euro dollar spiking higher, up by 0.6%. Euro dollar just short of parity, but still climbing, about 99.40, Tom, on euro dollar.
I wonder, John, if cumulative tightening, I love the phrase, it reminds me of my belt, but if you look at cumulative tightening, I wonder if that came from Vice Chairman Brainerd. It's a beautiful phrase.
Well, it's off the back of the speech, isn't it?
Well, off this market with the Dow up 300 points, SPX up 28 points.
Fed rates hikes by 75 basis points, and they expect ongoing hikes. That's the initial conversation we've had. So we need to be very careful with this then. So what are they saying? So what they're saying is we're going to need more rate hikes. We know that, but is there going to be a softening? Are we going to see 50 at the next one? So we got 75. We knew that was our most likely scenario. So if I come back to the notepad, we've got this, right? We're in one of these scenarios. Now we just need to see, does he come out dovish? In which case, I think the market can move somewhat, or is it going to be hawkish? Be very careful trading this, guys. The markets are pumping, but I don't see there's no like impetus behind this. Why would the market be pumping? We're expecting 75 basis points. The only bit could be pumping is the small percentage of the market. Remember, we said 15% of the market was expecting 50. So that could be what it is, but I don't know. I'm not too sure why the market will be pumping on this. I think it's just traders giving a little bit of volatility here. So let's see how that plays out. In the meantime, let's switch over to Bloomberg. Remember, the press conference is going to be the key, guys. That's just the interest rate. We expected 75. Now we need to wait for the Jerome Powell's press conference
that Michael McKee highlighted. It will take cumulative tightening and lags into account as they decide to raise rates. This really speaks to John to that moment.
Tom, quite a moment. Hey, we look for the news conference in about 27 minutes, and looking forward to it. I've got to say,
it could be interesting to see Michael McKee with us here briefly into the conference. And Scott.
This is very confusing on their document, right? This is okay, there you go. So 3.75 to 4. So this is correct. So they've increased the Fed funds rate from the baseline 3 to 3.75 to 4. So that's your 75 basis points there. Just want to check all the other details, which sometimes people gloss over, just to make sure they've not changed anything. So have they changed anything in the overnight purchases? No, doesn't look at it at a quick glance. All looks the same in terms of mortgage-backed securities, in terms of their principal payments of the treasuries. Fine. They've kept those caps the same. Nothing's changed there. Okay, good. 75 basis points. Now we can move on to the press conference. The press conference is what's really going to define this. Remember, on every other scenario, what did we see? We look at the situation here. You had crazy volatility. Remember this candle here? 30 minutes within the announcement. Big run up, big fall down, and then it came back into a doji. Huge volatility. So the next 30 minutes between now and the press conference, the market will do its thing. Just let it do its things. It's traders. Ultimately, it's going to be the press conference that ultimately by tomorrow will be the bit that matters. Let's see what you guys are saying in the comments. How are you feeling about this? Are you disappointed? Everyone's saying wait for Powell. So far, no rug, guys. We're not going to rug. The only way we've avoided a rug, which is great. A rug would have been 100 base points. Nobody was expecting that anyway. The only way he can rug a little bit is if he comes out really strict and really hawkish. I'm not expecting it. So hopefully we can get away without a rug. I think the worst we can have is maybe a 2% down day if he comes out aggressive. But right now, we're looking pretty good here. I mean, if we look at Bitcoin, trying to break out his triangle. But again, I'd ignore this for 30 minutes. Just chill out, ignore it, ignore the big wicks that come out of this. We want to see longer term what happens. Can we break out over, the next 24 hours are more important than just what happens immediately right now. We need to let Jerome Powell speak, see where the market settles. Let the traders just do their thing right now. It won't give you a long-term direction on where we're going just yet. When to the altcoins pump? No, I don't think it's a huge pump, right? Like you're seeing 0.8% here on Bitcoin. It's just if I call this sideways, because 75 base points is what the market's expecting. So it's not going to pump, it's not going to dump. This is just sideways action because we didn't get 50 base points. 50 base points would have pumped the market. We didn't get that. Okay? We didn't get that. Mark, yeah, initially on that thing, it said something weird on the thing when I think it was cached on my old browser or something, showed the old PDF. But yep, 75 basis points is what they've done. When is Powell talking? Powell will be talking in 24 minutes or so. We'll be covering that off together. M-Jab says Turkish rugs are nice, Habibi. Spencer, is this because the target is 4% and today's 0.7 hike puts us at 4%? Yeah, but I think they're going to increase the terminal rate, and this is what people are not understanding. So, yes, this brings you to a target rate of nearly 4%. So if we come back to that, let's just come back to that. Let me just... So you're sitting here now at 3.75 to 4, okay? So all that can happen is if we have another 50, if we have 50 base points in the next meeting, that brings you to a top bound of 4.5. They can still rate hike technically up to 5 and more. They can increase that terminal rate. And that's one of the things we're going to find out at the December meeting. I think we get an SEP, which is a summary of economic projections in December as well, which will further aid people. So this is what people are not understanding. One is you can rotate your hikes. You can start hiking at 50 base points, 70 to 75. But what if they just hike for longer? So it's a chicken and egg situation, right? We don't want him to just start reducing to 50 base points and then 25 eventually. We want him to not go deeper into the hike. We don't want him to go into the 5%. That's important as well. Ian says, got to go pick up the kids. Good stuff, mate. Go pick up those kids. Crypto weed, the news bearish or bullish? I call this sideways for now, guys. I think this is just sideways news. Yes, you're seeing a pump here in the market. Bitcoin up 1.2% now. Traders are reacting. But again, he's not come across dovish. So I'm not, why the markets are super happy with 75, I'm not sure.
Are you changing your estimation of where the Fed will have to go at that base rate? How high they'll have to bring it, given the lack of sensitivity right now in the underlying economy?
And look, I think the Fed has gone further than I would have expected already. I would have thought that the price pressures would have faded faster. So, I think we have...
This is something I want to cover off now. So now you look towards the December 14th, which is the next meeting, and you can see that half the market is pricing in 75 basis points. And the other half here, 47%, is pricing in 50 basis points. This is where the market is now really expecting this pivot. And this is what's going to be interesting, is to watch how this changes over the course of his comments. If he gives some comments that makes people more likely for this bottom scenario, 50 basis points, the market can start to price that in today. The market doesn't necessarily want to wait until the next meeting to price it in. If they can get a clue that he's going to do it now, they'll just price it in advance. Because remember, markets want to anticipate what's going to happen next. This 75 base points was priced in, which is why we're not expecting a crazy move. But if he says something about the following meeting, then you can get that crazy move because that's what the market's looking towards. Justin said he made some lunch money on SPY calls. Nice stuff. No signal says we are pumping. Bull market is back. Bottom may be in, says MJab. Gareth Jones. Anything else in the PDF which lends to a more dovish presser? How is the dot thing from last time? So there's no summary of economic projections this time. So you don't get the dot plot. You don't get all that. You'll get it in December. All you get right now is that statement and then a press conference. So in this statement, nothing else here to suggest why we're dovish. That's why I'm trying to switch over to the news to see if there's anything. But there's nothing so far apart from the fact that they want to continue their hikes. There's one thing for sure is we're not going to get a pause next month. I think they're going to hike again. Just want to know, are they going to hike 75 again, or are they going to do 50 for next month?
On end to 4.45 on a 10-year, we're down about 5 basis points to 3.98, and the dollar a whole lot weaker. Euro dollar positive 0.8%, just short of parity. Tom, euro dollar right now 99.53.
Yeah, and as Priya Misra talked about curve flattening, her trade was to go out months and months. Well, I think it's working right now in the last 14 minutes into 46 basis points off the vanilla spread from 51 beeps as well. John, I would really emphasize here the fancy math.
So a lot of people are talking about this triangle pattern. Like I said at the start of the stream, these triangle patterns, this is not a situation for you to play out. Are you going to break this from a technical perspective? This was a holding pattern for the price. All that happened was the price had some movement previously, and it just went into a holding pattern, knowing from here, from 25th of October, so for the last week, knowing that they just wanted to wait for the Fed meeting to decide on a direction. So it's not that this triangle, I'm not trading this triangle pattern. I'm not, I'm just using it as some structure on the charts. This was a purely macroeconomic based decision, which is going to decide the direction. So certainly am I not just saying, oh, we're trading this like a perfect triangle from a textbook. No, this is macroeconomic driven, as we've just seen from the Fed meeting. So you can ignore the triangle if you want. It's just a structure here on the chart.
The time that those hikes actually start to hit the economy and cause the pain we're all anticipating.
I want to clarify, John, I have no special knowledge that Vice Chairman Brainerd was part of cumulative tightening. I was just gaming there and speculating at length.
I think you're right to speculate. It almost echoes what she said in a speech a number of weeks ago.
Diane Swank with us now, who really understands the dynamics of the x-axis for a Fed in crisis coming out of a pandemic. Diane, Ned Gramlich, I don't think you studied this at Michigan. What in God's name, Diane Swank, is cumulative tightening?
Oh, I think we do know exactly what it is. It's the fact that we're 150 basis points ahead of what the Fed thinks is neutral now, and it's nonlinear in terms of its impact. We've already seen the destabilizing effect of rapid rate hikes in the housing market. That is, the most interest rate sensitive sector out there, but it's really been quite stunning and also starting to show up in prices as well. That's something that we know from the housing subprime crisis. It actually showed up in inflation measures much more rapidly too, and the Fed's starting to look at that. And I don't think it was just Lael Brainerd alone. I think this wording allowed the Fed to do a unanimous vote. First of all, it's in line with the Fed's, summary of economic projections. They were expecting 50 basis points and a quarter, so it's in line with that. It's also important, though, that you didn't just have Lael Brainerd lay out financial instability issues. You had Esther George talking about not the terminal rate, still wanting a high terminal rate, but getting to...
A lot of people are interested in the trade right now. So yes, that's very normal. Like we've seen, we studied the previous ones, right? Lots of people are going to be trading this. This first half an hour is crazy volatility. Again, look at May. This candlestick here where my cursor is, run all the way up, came all the way down. Look at June. Okay, you had your announcement, you ran up, and then you lost it all down, and then you came back some way up, right? So this is what the candlesticks are telling us. You look at July, lots of volatility, but this was a big pump here on July, and it stayed that way, which was interesting. Big day on that day. And obviously, this was what happened on this a 5-minute candle here when the announcement was made last time. Big dump, but then it recovered during the press conference. So this is interesting. We need to see what happens here. A lot of traders will be interested, but Jerome Powell can just keep this pump going if he says positive stuff. And normally he's quite good at that. So don't hold the hopes up that we're just going to rotate to the downside. Maybe before he speaks, but hopefully once he starts speaking, if we're green before he starts speaking, if we can maintain this for the next 20 odd minutes before he speaks, 16 minutes before he speaks, then he can do the rest to keep the markets green. It just depends if he wants to. And that's what we need to keep an eye on. Or does he come out really strict to put the market back in its box? This is something we're going to have to see. Ultimately, he doesn't want the markets to get carried away, but at the same time, he's got these midterm elections. We've got to be really, really aware of that.
Have a national housing price correction. Of course, we've had a tremendous run-up in housing prices. There's still a lot of cushion, not the subprime crisis. But the more rapid that occurs, the shorter the lags to when it not only shows up in measured CPI and measured PCE, which are important for the Fed, but also, more importantly, what it means for renters and people, home ownership costs. Those.
So there, let's take a quick look at the markets. Bitcoin, just giving some of that up. It was as high as 1.24. It's just dropping back down now as the traders play around. Other movers, Ethereum moving 1.1%. Sorry, you've got Binance Coin 1.4%. Nice move there on Binance Coin. Let's see how Doge is doing. Doge is dumping, which is interesting. Down 3.8%. 0.81% today, although it's been doing pretty well, to be fair to Doge. So it's holding up pretty well there, relatively, 13.6 cents. What else have we got moving? Cadena moving 1.7%. 11% on Litecoin. Anybody know what's going on with Litecoin? Put it in the comments. We've got Litecoin moving. VeChain moving. H-bar moving 2.5%. Interesting. Okay, overall, nothing too crazy. Got the 75 base points as we expect, guys, and it's still boring market, unfortunately. Boring market, sideways market. It's good that it's boring in the case that we didn't get rug pulled, but we definitely didn't get the pump story. It would have been nice for once to get a surprise to the upside and for Jerome Powell to be nice and give us 50 basis points. We can see an 8% move on Bitcoin. That would have been really fun, but we haven't got it. And it's interesting because it shows that, you know, he's taking this really seriously. If he's not poor, if he didn't go back down to 50 basis points before midterm, it means he means business. It means he does not want to let go and he's going to continue, which is interesting, very interesting.
And that's what the 8 minutes, 34 seconds in Jackson Hole was all about.
The 8 minutes and 34 seconds heard around the world, more than probably any of his other many minutes. Scott, I want you to weigh in. Diane commented on this too, this fear of a financial accident and how that's an outcome that the Fed does not want to see because it will cause them to step back before their work is done. What's your sense of the potential trigger point, right, of how close they might even know that they're getting before they trigger some event at a time when you've got private markets that aren't really trading that much, and if they are, it's at pretty distressed levels that people kind of sweep under the rug, and you've got public markets that seem very orderly?
Well, I think
just want to fill everybody in on this. So what allows Bitcoin to move? Remember the dynamics, right? So you got dollar index. If dollar index is having red, which it's having now, that's favorable. That is favorable, therefore, for the for Bitcoin. They're inversely correlated. Same with the US 10-year, right? The rate hike means this goes down. Redness causes weakness in dollar index, allows Bitcoin to move in.
Hey, you know, let's talk about the terminal rate. Let's, ease into the idea that we could be slowing the pace down to get inflation to stabilize and come down. Because I think that, over the last 6 weeks since the last meeting, when you look at what's gone on in Japan with yield curve control and the depreciation in the yen, and then the unexpected collapse in gilts that occurred around the LDI.
Guys, 13 minutes until Jerome Powell's press conference. Make sure you go grab a snack or a drink or something, because that guy can waffle sometimes depending on the questions. But we will be monitoring that together. We'll keep the charts open at the same time to see which questions move the market and what are the markets looking for. That's going to be important. Remember, like I shared with you in the previous ones, it's the press conference that gives you most of the volatility in terms of the candlesticks. We do want to wait for that. That's going to be important for us. In the meantime, let's see what else we've got moving. Phantom is up on the hourly candle along with everything else, but it's down from its trend, right? It's fallen out of its parabola. A lot of people asking, why is it falling? I mean, it was just on such a steep trend. I mean, we monitor it on this parabola. It's broken its trend and it's come down. But if you zoom back out to the daily, bring out the daily EMA ribbon. Oops, and just get zoomed in here so we can see that together. You can see what's happening. It's just coming down into its EMA ribbon. Can you see that? There you go. It's just coming and trying to get some support from its EMA ribbon. And this is going to be the key. Does it lose its EMA ribbon or can it bounce from here? If it can bounce from here and go start posting higher highs, then it can keep its uptrend. But ultimately, this just depends on Bitcoin doing the same thing, right? Bitcoin's above its EMA ribbon. This is a consolidation period into our triangle. Can we now work our way on our next leg up? That's what we need to see on Bitcoin. And I think Jerome Powell in the next 15 minutes is going to decide over the next couple of weeks, how's the market going to react? Are we going to have a good couple of weeks or are we going to have a bad couple of weeks? That's now what this is going to determine. The next Fed meeting is about 6 weeks from now, December the 14th. So that the movement we're going to get in the next 6 weeks is largely going to depend on this. Is he going to give us a clue of this 50 basis points, or is he going to continue to say we're going to keep rate hiking? Remember, and I think people are losing sight of this 75 basis point rate hike is big. It's an extremely hard and fast rate hike. And now you're 1.5% in terms of the interest rate in tightening. So 1.5% ago, this rate hike and the previous rate hike of 75 basis points, we were at neutral. In other words, the Fed was neither accommodative, they weren't printing money, nor were they hoovering money. On net, they canceled each other out, and you were neutral, right? You just weren't aiding the economy. Now you're 1.5% actively tightening. So this is a big deal, right? We are actively tightening, which we haven't done for a very, very long time. We've obviously been in very accommodative situation for a long time. and obviously during the pandemic as well. So this is something important for us to understand, is these 75 base points, they're not a joke. Before Jerome Powell started doing them the last couple of months, we didn't see one since 1994. So at some point, he's got to slow that down and bring it down to 50 basis points, or he's going to wreck the market. Okay, we're already seeing here on the ADP jobs figures, most of the industries were coming down. Obviously, this one skewed it, which is showing that the labor market is really strong. So maybe he's going to come out and say the labor market is strong, but we know as leisure and hospitality is propping up the rest. Otherwise, it would have been a really weak jobs figure, right? Because a lot of these major industries were down. 17,000 here, 10,000 jobs lost in financial activities, 14,000 jobs, right? There is softening of the labor market. Demand destruction is happening. And on top of that, if China, we've had clues earlier this week of China relaxing its COVID zero policy, that could fix things from the supply side. If we could fix things from the supply side, Jerome Powell's already tightened stuff up from the demand side. We should be seeing inflation come down. And that's why the next CPI reading is going to be really, really important. Alexis says, why do I have this bad feeling we are going to dump hard once he starts talking? Yeah, that's what I'm worried about too. Worried about the same thing. We're on the same page, especially when we've had this run up. It is possible that we can dump. Also, what's possible is it can dump after he finishes talking. So let's go back to, which scenario was it? It was this scenario. The last meeting we had, we fell on the announcement. We picked stuff up as he was speaking because he was good at soothing the markets. And then afterwards, people just go, hang on a second, this ain't good. And it just gave it all back up after the meeting finished. Right, so you can see that was later on in the day, 8:30 my time, 9 o'clock UK time. It's just started giving it all back up, and you ended up worse than before the meeting. Okay, so that's something we need to watch out for here over the next 9 minutes or so when he starts speaking. Any other questions, guys? Pop them into the chat. Let's cover those off. We've got 9 minutes to cover those off if you guys have any questions about the markets. Midnight Relaxation says, I will buy like never before if we dump. Yeah, so again, if I was new to the market, if I hadn't had all this opportunity to be buying, these are beautiful price points, right? I mean, even if Jerome Powell shakes the market and you fall back below 20,000, these are historically lovely prices back at the 2017 market highs. So for me, those are good prices. But of course, I've been in the market for a while. I've been spoiled in being able to buy around this 18,700 level. Even when Bitcoin dropped down to 17,700, I had some limit orders in here which picked up as well. So those are the prices I'd want to get excited again, right? I'd want to be at the bottom of this channel. But at the same time, if we get good news and we go to the top of channel at 22, start working our way out of here, great, let's go. My bags are ready and I'm ready to go. That's why I'm in the market. I don't yo-yo and say, oh, I'm in the market, out the market, in the market. I sit in the market, I have conviction, and I just add more when I need to add more. I keep this stuff really simple, guys. A lot of people want to complicate it. I just keep it really simple. Bitcoin now up 1%, Ethereum up 2%. So Ethereum is not messing around right now here on the news. But Ethereum, remember, needs to post a higher high in order to really get this uptrend going. It needs to go post a higher high, then it can come down, and then it can start working its way up and down with higher highs and higher lows. Guys, don't forget to check out my free TA course, by the way, ijaz.uk/TA. Links in the description, completely free. So you want to learn all these chart patterns, you want to learn head and shoulders, Fibonacci, you want to learn EMA ribbon and how I use all these things and plot trends and what's a doji candle, what's a dragonfly candle, what's bullish engulfing candle. It's all in there, completely free. Won't be free forever because I know people won't use it. Go use it, make the most of it, take notes, and hopefully you guys pick up all this TA stuff before the next bull run so you're fully equipped. If you already know TA, great stuff, but go refresh your knowledge. There'll definitely be at least one thing in there which you didn't know. Always look to learn, guys. Always look to learn. Okay, so 7 minutes until Jerome Powell speaks. You guys are saying, how is the 10-year yield? We covered that off. Falling. Arcana says, I open a short position. Marco says, my concern is I am all in after the BTC breakout, have nothing to buy with if we dump now. Yes, very important thing you said there, Marco. So this one of the strategies I use is I always want to keep a certain percentage of cash. Now, from a textbook perspective, 15%, 12% would be nice. Realistically, because I get greedy and I just buy, it ends up being 8%. So it's a constant battle of keeping cash available. And I always challenge myself to invest it. So let's say it goes down to 6%, 7%, and I have to go find cash for my other business ventures or whatever else I'm doing to bring that stockpile back in so I'm ready to buy the dip. That's the game. You're absolutely right there. What a new investor, new trader does is they get money and they throw it in the market. What a more experienced one does is keeps that little bit of cash on the side, because 10, 15% cash on the side, if the price drops another 20%, it's hugely powerful because most people don't have the cash to buy those dips, right? So definitely you bring up a really important point, Marco, and it's something a lot of people do not think about. Rory, you're the man, Ijaz. Thank you. Appreciate you, buddy. That's very kind of you. Dude, I watch a lot of your videos. First time watching the stream. Great stuff. Welcome, Louis. We should do more of these streams, to be honest. I don't know why I don't do more streams. If you guys want more streams, let me know. Hit up the likes, comments. If I see the likes go up on these streams, then obviously I'll know that this is what you guys want. Akash says, Ijaz doing the Lord's work. Thank you. Appreciate you, buddy. And I know this is not the most attractive stuff, guys. This takes hours of research to do this. And I know it's not attractive. I can easily, you know what the other crypto channels do, guys. I can just make a moon video, flipping drive a Lamborghini for 10 minutes outside, and you're going to get more views. But I'm here because this is the reality. This is the reality of what a trader does. This is what I did when I was in traditional finance. I do it now to apply it to crypto. And there's nothing different. I don't claim to know everything. I don't. I learn it and I show it to you in front of you. What I'm reading, when I read the ADP jobs report, I'm just exploring it with you. I'm just a normal guy like you, retail investor. We read this, I open up the report, I break it down, I want to look at what's priced in the market. We're doing this together and I'm showing you. And if you guys want to make use of it, great. If you don't, then there's other channels you can go watch to do that, right? You can go follow a Moon channel, which no doubt every single day will say Bitcoin's either going to 5,000 and then the next day Bitcoin's going to 100,000. There's no in between. There's no realisticness, right? Like they're not even covering the streams today. Right, and that's how you know the channels aren't here to really educate you. They're here to just make videos on the days where they're going to get views. As soon as there's a green day where Bitcoin's moving 8%, those channels will all make videos. All make videos on those days. On boring days like today, where I told you at the beginning, 75 basis points. What did I say? I told you straight away the most likely scenarios. Did I? I said this, and straight away we got there. So I knew going in today we were going to get 1.1 to 2% down, or maximum 2 to 3% up. That's what I'm expecting. Right? I didn't expect this crazy, exciting day. We've still got to cover it off so we know what happens in the markets. We can be pragmatic and we know how to invest. And that's what I want this community to be. I don't need it to be millions of people. I just want a few people here that are interested on how to do this the right way. MJAB, very hard to buy the fear and sell the greed. Very, very hard. This is psychology. Again, not a lot of people talk about it. You can know what to do, but then to do it is another thing. And the reality is you're never going to be perfect today. I constantly have to fight my psychology. It's like going to gym, right? You've got to keep doing it. Keep training yourself. Really mess with your emotions. You're absolutely right. Mark goes, what if Jerome Powell's mentioned Shiva? That will go to the moon. That'll be brilliant. That'll be better than Elon mentioning it. Stu says he wants more streams. Cool. Let's see if we can get more streams done. If we get more likes in here. Only half the people have hit the like button, guys. Do appreciate it if you can smash up the likes. Doesn't cost you a penny, but really does help. I know it sounds silly, but it does help. Dave says, thanks for helping us out. Oh, you're very welcome. Deep says, I dumped all my bags. The only bags I have. Okay, cool. Ebjab, Leandro Silva, hi from Portugal. Hello from London. Fareed, appreciate all your work, Jazz. I'm constantly sharing your vids with the boys. Nice, Fareed. Really appreciate it. Little things like that really help. Sharing it with 2-3 people really helps to get the message out. Jazz says, Moon Boy. He's stupid. Yeah, okay. Shakir says, love your honesty. Appreciate you, buddy. He's putting all the Moon Boys in the chat. Nice. And yeah, and that's the other type of person you get, right? You get people just kind of every day come on the stream and just be like, oh yeah, markets are fine. Keep dollar cost averaging. I'm trying to actually give you the insight. And the stuff I'm sharing with you, I know that the banks are doing this. I know whether it's Morgan Stanley, Credit Suisse, JP Morgan, this is how they react. That's why I want to share it with you, because this is the data they're looking at. Obviously, they've got better access to data than us. They're paying 25 grand a year for their Bloomberg terminals. They get all the best reporting. But the functional aspects of what they're doing is what we're doing here. Analyzing the data we analyze every single day and look at the patterns that we're looking at. I know because they paid me to do that. Stuart, forgot to press the like. You are more than worth one. Appreciate you, buddy. If Bitcoin replaces fiat, which ceases, then why would you compare it against to determine the value of it? As in, what would BTC be worth when buying things? It just comes out, it's supply and demand, right? I'm not sure if I understand your question, deep random thinker, because you're clearly a deep thinker. But it just comes down to supply and demand, right? What do people value at? How many Satoshis do you want for a chocolate bar? And it will determine the price, right? You don't need to benchmark it to dollar. You become the dollar. Everything benchmarks to you, right? If you replace everywhere where you see US dollar, you replace it with BTC. That's where, if it wanted to get there, that's where it would need to get to. Leandro, thanks for doing this. Marco, we have to keep in mind that there's a lot of cash on the side. If the price is not going to dump, then that money is going to FOMO in. Absolutely. Absolutely, Marco. And this is one of the things we have to remember. There is indeed a lot of cash on the sidelines. cover this point afterwards. I don't want to miss Jerome Powell.
Taken by the force of this phrase.
Good. We got a little bit of time. So there is a lot of cash on the sidelines. And right now, there's no money to be had anywhere. The only place you're making money is in a US 10-year, right? Which at the moment is giving you just here under 4%, 3.99, risk-free. So that's the most attractive place for people to put their money right now. Other than that, for anybody who wants more than that, which most people with less than £1 million don't just want 4%, right? If you're on 100K and you get 4%, what are you going to do with $4,000 every year? It's not going to change your life, is it? So most people who don't have $1 million, they want more than 4%. So there's nowhere to put their money right now. So when the markets start to move, that money's going to come in very quick into growth stocks, Tesla, all your high-tech, fast-growing stocks, and then also Bitcoin as well. It's just how things go. It's the normal cycle of how things rotate. Omar Farouk, thank you for your nice words, Mr. Presti. Can you do a token breakdown on SNX or ILV? I'm curious what's a good base target. Possibly, if there's demand for it, we can do that. Mowgli Khan, deploy cash or sit on the side for a little more time. Depends on your personal portfolio, right? I've got enough in the market. Okay, let's Jerome Powell.
Ability of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Real GDP rose at a pace of 2.6% last quarter, but is unchanged so far this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 289,000 jobs per month over August and September. Although job vacancies have moved below their highs, and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in September, total PCE prices rose 6.2%, excluding the volatile food and energy categories. Core PCE prices rose 5.1%. And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional upward pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored.
I love how they blame the war and never talk about the printing they've done over the last year.
Businesses and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Financial conditions have tightened significantly in response to our policy actions, and we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
This is what we're expecting, guys, right? Fed acutely aware that high inflation poses hardship. Again, going into the midterms, he's got to say, I'm with the people, not with the stock market, I'm with the people.
Which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
Oh, man.
We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
Not fun, but accurate. That's what we want to do.
Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Oh, man, Jerome Powell, you're wrecking our portfolios, man. God damn it, Jerome.
Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a...
Crypto banter. We've got some crypto banter viewers. Come on in, guys. Listen to Jerome Powell wreck the markets in front of us.
Could potentially proceed with independent of that data, given the lagged effects that you mentioned.
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned. We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was and has been how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate. And we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time. And we put that into our post-meeting statement because that really does become the important question, we think now, is how far to go. And I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean. And we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
There you go. Markets liked it a little bit, but I feel like they're reading too much into it.
Nick Tamaros of the Wall Street Journal. Chair Powell, core BCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher. I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And, I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, people who publish an assessment of underlying inflation.
Thank you.
Oh, Jerome. Rugging us, man.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting. And we don't think those are as indicative, but they may be important in the wage setting process. There's a school of thought that believes that. So that's very concerning.
A lot of people asking, are we going to be up? Are we going to be down? Like, I don't think the markets are going to digest this too well. I don't think we're going to get crazy falling. It's just not a nice meeting. 75 base points as expected, and he's not coming out soft. So he's not giving us a bone to play with. So I don't think we're going to dump hugely, but he has rugged us a little bit. He's just being mean, and he's putting redness in the market today.
And so, the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And, the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well.
By the way, guys, I will be summarizing this afterwards. I will do like an 8-minute video summarizing everything that's going on so we're aware of what my game plan is as well. But remember that you need to let this settle over the next couple of days. Now, some people are arguing that the initial run we saw was because markets don't like uncertainty. That's true. Markets don't like uncertainties. And now with 75 base points, at least we know. But I disagree. That's why we saw the green. The green was a bunch of trader activity. Okay, and then they're looking to bring that down like we just saw. That would be the case if there was a perception that he could have done 100 basis points. If there was a perception he could have done 100 basis points, then he does 75, that could have argued the green. But nobody was expecting 100 basis points. None of that was priced in for 100 basis points. So most of the markets were expecting 75 with a small 10-15% expecting 50 basis points surprise. That would have been a nice surprise to the upside.
In the middle, looking carefully at what's actually happening with the economy and trying to make good decisions from a risk management standpoint. Remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lags. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy. We need ongoing rate hikes to get to.
There's no chance of pausing and sitting where we're
at. To that level of sufficiently restrictive, and we don't. Of course, we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting, a new summary of economic projections, which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Thanks, Chair Powell.
As long as Bitcoin's above 20, it's all right.
As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors, you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have.
So far, no clue on this pivot, right? He's sidestepped the question. He's not made it clear if it's 50 basis points. He said it could be, it could not be, right? Very clear. What he hasn't made clear is we're not pausing. So we're definitely not going to have 0 basis point rate hike for the foreseeable future. And the question still remains, is it 75 or is it 50? So it looks like we're not going to know.
Sorry, was I getting to your question there? Housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
Victoria.
But look, he's just covering off. He's saying the housing market is correcting. We knew that, right? He wanted to wait to see housing market correct. Now, some people are saying, oh, look, the reason everybody's suffering and waiting for the market to return is because everybody sat on bags. And I just wanted to pick up that comment from whoever posted that. Who was it? Alpha Metro. Look, some people have bought the tops, right? Some of you guys did buy in November. And when I first came into crypto, many bull cycles ago, I got shook out and I never came back. I was disenchanted with crypto. So I took an L. Then I came back, took another L, went back again, back to my stocks. Right? You only start building a good portfolio if you DCA through bull markets, through bear markets, and be around. If you've been through bear and bull, you've had the opportunity to buy in both. Then you get those low cost prices. If you just every time come in because your friend tells you in a bull market, that's not the way.
As quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside, that if you look at private sector workers, that did come down, the compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply.
Market is not having this, guys.
Job creation still exceeds, the level that would
how
hold
long for,
the
right?
market
Is it going to
where
break
it
the
is.
20,000 level?
So that's the picture. Do we see? We keep looking for signs that sort of the beginning of a gradual softening is happening. And maybe that's there, but it's not obvious to me because wages aren't coming down; they're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see. We would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we think we can. We do think that, given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine, and we're seeing China's having issues with the zero COVID policy and much slower growth than we're used to seeing. So we see those difficulties. The strong dollar is a challenge for some countries, but we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%, core PCE inflation, which is a really good indicator of what's going on for us is, the way we see it, is running at 5.1% on a 12-month basis and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
He's waffling.
Hi, Chair Powell. Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. That's, we now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures and also all of their trades, any trade anyone has to make.
Guys, while he's waffling, please take a moment to smash up the likes. Don't forget to subscribe if you're not subscribed. If you're new around here, we do daily crypto videos. Yes, daily crypto videos. Go check out a couple from the last few days. See if it's to your liking. Hit up the subscribe. Now, don't want to interrupt Jerome Powell any longer. Also, check the links in the description. Free TA course. Go make the most of it. It won't be free forever.
To each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. Once that happens, I don't discuss it with the Inspector General or with anybody. It's just the Inspector General has the ability to do investigations. We don't really have that, so that's what he's doing.
Michael. Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right. And that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted. And also, you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up. You also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that risk assessment has changed a little bit?
Well, what's happened is time has passed and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right. But if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking. And
guys, if you think he's waffling, give me an old man in the comments, like, oh man, like, oh man, like, in the comments if he's waffling.
That's really how I look at it. So, that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the place, what's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, it doesn't. We'll have to see. There's been no decision or discussion around exactly what steps we would take at that point. But the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
So this is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as non-new leases roll over and become and expire, right? There's still in the pipeline. There's still some significant rate increases coming, okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which at which rent inflation will start to come down. But that point is well out from where we are now. So
while he's waffling about that, guys, the main bit we need to focus on is what he said, right? The ultimate rate level is higher than expected. So everybody's arguing when's he going to slow down the rate hikes, but he's just told us he's actually going to have to go deeper into rate hikes. The terminal rate needs to go higher. Okay, he said there's a need for ongoing rate increases. He's going to have to keep going. He also said if we over-tighten, which he doesn't think we've done already, if we over-tighten, we can always use our tools to support. In other words, he's saying, look, if we over-tighten, if I get this wrong and we over-tighten, I'll just print again. It's not an issue. But if I don't over-tighten now, inflation will become entrenched, and that's a harder problem to resolve, okay? So he's erring on the side of caution, saying I'd rather over-hike, and I think that probably makes sense. In reality, it's just painful for the markets right now.
What I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher, and that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another they go up, and that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go.
We got it.
And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward. Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
So what about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's
guys, did you notice that when the reporter said that the markets were green, and then Powell further put his foot on the market, but the market's not green. It was green initially. The reporter was wrong. The reporter didn't have the up-to-date data. Then Powell's going even harder in the paint to stop the market from rallying, but the market was already red.
So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given. But we know what our objective is, and we know what our tools can do, and that's how we think about it.
Thanks. We'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer from Marketplace. I'm wondering, has the window for a soft landing narrowed?
Good question.
Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path has narrowed over the course of the last year, really. Hard to say. Again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists,
above 20K, so I'm quite happy.
There is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that
And by the way, guys, I'm just reading the sentiment in the comments. You're right to be annoyed as an investor. We're getting the crap end of the stick. Inflation is horrible. Markets are dead. Interest rates are tightening. We're in tightening policy. Like, the generations before us had it so easy. It was easy to buy properties, to invest. Markets were accommodative. 0 interest rates. We're getting slapped. So you're right to be feeling the pain, but you've got to be pragmatic. Don't get disheartened. Keep investing. Keep learning. This is a long game. When most of the people leave, that's when you want to be doing the work. That's where it is now. People don't care right now. That's why I want you guys to care, because I've made the same mistake before.
Just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now. And it really hasn't, although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say. Thanks very much.
Right,
that wraps up the Federal Reserve's November meeting live from New York City. Good afternoon to you all. Here's the price action off the back of it. Equities down. The takeaway here, the risk of doing too little outweighs the risk of doing too much. We're down by more than 1% on the S&P 500. On the NASDAQ, we're down by 1.6%. In the bond market, not much movement here. I've got to say, at the front end, we're higher by a couple of...
Right, guys, so there you have it. Jerome Powell's press conference. Look. Let's just zoom out. I know it's quite emotional at certain points, but we got what we expected. Let's go back to our notepad that we started this whole scene with. We started off the day with these different scenarios. Yes, we could have had 50 base points. We could have gone to the moon. But equally, we could have had 100 base points and gone rocketing down 6%. Where do we sit right now is that Bitcoin is flat. So all in all, if you look at the predictions we had, I said we're going to be between 1 to 2% down, most likely scenario, to 2% up. So in between, right, these two. He wasn't too hawkish, but he was hawkish. I put him closer to this scenario, and it was the most likely scenario that played out. So no need to over panic. We got what we expected. Yes, some people get excited and we're expecting 50 base points. It's always nice to be surprised by a 50 base point rate hike. At some point we will, right? Maybe it's the next meeting. Maybe it's the next rate after. But we need to focus on some of the other things he was saying, which is a pause is not on the radar. Okay, fine. I don't think a lot of people are expecting the pause. I think more importantly is how he's saying things like, we need to now stop focusing about the speed, but the length of the rate hike. So in other words, he's saying, look, we need to rate hike for longer. Okay, and he's not scared to over tighten. So these are the things we need to be now aware of. And it just is a depressing period to be in. But the good news is this, guys. We're closer to the end of this rate hike cycle than we are to the beginning. And I think that's important. We've had 4 75 base point rate hikes. Before these 4, one since 1994. That rhymes. But that's reality, right? It's been a tough rate hike cycle. And now we need to make sure we understand what is going on and how to react. The way to react is let the redness come in the market. If there's redness in the market, fine, we'll buy. But the reality is I don't think there's going to be huge redness over the next couple of weeks. I don't think there's going to be huge. You know, depending on what he could have done, we could have seen real big falls here. But I don't think we're going to see that. I think hopefully with a bit of luck and the market's moving our direction, not only can we hold some support maybe at 20K and start working our way up to 22, hopefully we can avoid lower prices because it's holding up okay. And I just want to avoid this M pattern. This M pattern is the one I don't like. I don't want to see us come down to 20, not even to test it. If we do, I want to see a quick bounce back up. If we do come down here, I just want to see quickly go back up, right? And then we can try hold some green. Look, ultimately, markets want to know what they price in. And now the focus will completely be on the next meeting. And let's take a refresh, see what is expected. You can see that markets have put the 50 basis points in. 60% of the market is now pricing in 50 basis points for the next meeting, okay? So this is what's going to yo-yo over the next 6 not going to stay this way. And as this prediction, what people expect, changes, the markets will change accordingly. This is going to be the narrative over the next 6 weeks. And the reality is, until the Fed doesn't start slowing those rate hikes down, until we don't start seeing... I need to explain this. A lot of people get confused between a pivot and a U-turn. They're very different things. What's a pivot, right? A pivot is when you change direction. A U-turn is when you turn around and go the other way, right? Different things. A pivot is when he goes, I'm not going to do 75 base points, I'll do 50 base points. He's still hiking. He's just hiking slower. He's hiking in this direction. Or he's moved into that direction. That's a pivot. A U-turn is when he says he pauses or he's going to start cutting rates, right? Two different things. So let's not get confused with our terminology. We need to understand what those are. And it's when we see those things happening, we can start to see the markets feeling a little bit more confident. So there you go, guys. We've got to wait over the next kind of 24, 36 hours to see how does the market settle in and how does it want to react. At the moment, we're seeing a flat market, kind of taking it in. Ultimately, look, it was the 75 base point rate hike we were expecting. But then alongside that, you've got really hawkish tones. I lean it to the hawkish side. Dodge the question like a politician should in terms of whether we're going to see 50 base points at the next rate hike. He said we could or we couldn't. And he said the labor market is still tight. He said all the normal stuff that he says. He wants to see inflation come down consecutively. And he's right. It hasn't come down, even on the goods and services side. So we can't even blame the fact that this is all supply side shock. Some of the demand side goods and services are still showing inflation. And so this is getting him worried that the inflation that we were looking at can start to become entrenched. Right? You do not. Remember, if you go back to the Paul Volcker times and study it, he brought inflation down, but then it stayed at 4 or 5% for a long time. I can't remember how many years, but it stayed there for a long time. But Jerome Powell has made no mincing of his words to say, no, not only do I want to bring this down, I don't want to bring it down to just 4% where we can manage it. I want to bring it all the way down to 2%. So he set himself a lofty objective. And now, is he going to change his mind? Is he going to flip-flop and say, oh, no, I just want to get it to 4% and then I'll be happy? Because that's what Volcker did. Volcker increased the interest rates and got it down from whatever it was in the 20s. It was high, right? He got it down to 4%. And then he kept it there before it, then later on, like years later, came down to 2%. This is something we need to understand, right? Guys, don't forget to smash the like button. Don't forget to subscribe. If you missed some of that or you're not sure what's going on, I'm going to put up an 8-minute video if you guys watch it in ×2 speed. But with my speaking, then you'll be done in 4 minutes to summarize everything that just went on and what my plans are over the next few weeks. Thanks for joining me on this live stream, guys. Really appreciate you. Don't forget to smash the like on the way out. If there's anybody who wanted to watch this live stream who didn't quite catch it, send them the link, and I'll see you in the next one.